Hello and welcome to the Daily Brief Show by Zerodha. Here we cut through the noise and bring you the most important stories that move the markets. I'm your host Anurag Bansal and today is the 21st of August. In today's episode, we'll talk about four big stories. In the first story, we'll talk about India and Vietnam's trade wars. In the second story, we'll talk about increase in private capex in India. In the third story for the day, we'll talk about what is happening with the Indian economy. And in the fourth and final story, we'll talk about deposit credit growth in the country. By the way, you can also listen to this episode on Spotify, Apple Podcasts, YouTube Music, or as a video on YouTube. You can choose wherever you get your podcasts. We also send out a crisp and short daily newsletter that captures the essence of this show. If you are interested, do subscribe through Substack. A few days ago, India initiated an anti-dumping investigation on imports of steel products coming from Vietnam. The reason is Vietnam is said to have been dumping their steel products in India and the domestic steel players don't like this at all. Companies like JSW Steel and ArcelorMittal Nippon Steel are concerned that these cheap imports are damaging their business by making it hard for them to compete. This is because they cannot match the prices of Vietnamese steel makers. So to solve for this, India has launched an anti-dumping investigation into hot rolled coil or HRC steel imports from Vietnam. Now for your context, HRC is a type of steel that is used to make things like car parts, building structures and machinery. Now while this seems like a good step, the thing is India does not really import much of its steel from Vietnam. The real problem is China. India, like many other countries, relies on China for a lot of things, especially steel. According to S&P Global, in July alone, Chinese steel is expected to represent 73% of the total steel imports. Now see, over the last few decades, China has become an economic powerhouse largely because of the massive government investments in infrastructure. China has spent massive amounts of money on constructing everything from highways, railways, power plants, heavy industries to even massive urban housing projects. And this has helped China industrialize rapidly and has turned it into an export powerhouse and the world's factory. Now all of this obviously required a lot of commodities, particularly steel. Now in order to make all that steel, China needed vast amounts of iron ore, which is the main raw material for steel production. As China kept building and expanding, it became the world's largest consumer of iron ore. This huge demand pushed iron ore prices to record levels over the last 25 years. But things have started to change now because China's economy is no longer growing as fast as it used to at one point in time. As a result of this, China no longer needs as much steel as it once used to require. China has now ended up with a lot of excess steel production capacity and they need to do something with all this steel being produced. In fact, the world's biggest steel producer, which is based in China, said that the conditions in China's steel sector are like harsh winter that will be longer, colder and more difficult to endure than we expected. And that is definitely alarming. So where does all this surplus steel go? See, like I mentioned in the beginning, they dump it in countries. But the biggest problem with this dumping is that everyone in the world may start becoming dependent on just one country. And the result of that could be China becomes even more powerful in global trade. And that is a big risk. Why, you may ask? See, China's dominance in global trade means they could start using their power to push other countries around. For example, if China decided to stop selling certain materials or products, these countries would be in big trouble because they rely so much on these imports. Also, since China produces so much more than it requires, it can sell its products very cheaply, which might push domestic companies to go out of business because they just cannot compete with others. Chinese steel imports are affecting steel prices already. In mid-July, Chinese cold rolled coil or CRC, which is used for making things like home appliances, car body panels and furniture, was sold to Indian importers at $610 per metric ton. Even after adding a 7.5% import tax, the Chinese steel was still over 4,000 rupees per metric ton cheaper than the same type of steel made in India. But it is not just India that is facing the heat. Other countries have joined on this too. Brazil has set a limit on how much steel can be imported from China. If more steel is imported than the allowed quota, the extra steel will be taxed at a much higher rate. They are doing this to protect their local steel industry from being hurt by the flood of cheap steel from China. Now, this phenomena isn't just restricted to the steel industry, but various other sectors as well. US and Europe have been imposing tariffs on goods from China, especially on things like electric vehicles, to protect their own industries from being overwhelmed by cheap Chinese imports. For instance, in US, Joe Biden recently announced 100% tariff on electric vehicles and 50% tariff on semiconductors and a 25% tariff tariff on EV batteries imported from China. Europe also decided to impose extra temporary tariffs of up to 38% on EVs imported from China. Now, this is a very fascinating trend that is shaping up now, and I'll be sure to explore more about it in the future. Moving on, let's talk about how the private sector in India is hot once again. See, most of us hear the word GDP almost every day, but not many of us know what it really is. See, simply put, GDP measures the amount of economic activity in a country. It is made up of what the country's people spend, what its government spends, what people from abroad spend in the country, and finally, also investments. See, a large portion of this GDP calculation is investment. Investments are also important because they are a leading indicator of the economy. In simple words, this means that higher the investments, the higher is the growth that is expected in the future. Now, these investments can be made either privately or by the government. Now, something that the current NDA government has done very well is ramping up infrastructure related investments in our country. In fact, over the last few years, government capex has been pretty much the biggest reason why our economy has been growing. Private investments have barely changed. But there is some reallocation happening here. Even though government investments are increasing, if you break things down, while direct investments by the government are going up, PSUs or public sector companies are reducing their capital expenditure or money they spend on expanding capacity, building new plants, etc. According to a Motilal Oswal report, from about 2.3% of the country's GDP in FY 2020, PSU investments have fallen to 1.2% in FY 2023. Another very interesting fact is that PSU capex was only 40% of the central government's capex in FY 24, but about 10 years ago, it was almost 150%. Now, this means a lot of government investments is being made directly instead of being routed through PSUs. Now, this could be intentional because PSUs are largely inefficient, or could also be for another reason, we can't be sure. Now, in an ideal situation, government infrastructure investments should be followed by private investments. Think about it. If the government builds a road from point A to point B, in an ideal scenario, it is only useful for the economy if people on the A side can start trading more easily with people on the B side. So you would expect that after the government's investments, a lot of private investments would follow in order to facilitate this trade. But very strangely, since 2011, this has not happened. Until 2011, our private investments were quite high and were consistently rising. They rose from around 10% of our GDP in the 1980s to around 27% in 2007-2008. But since 2011-12, they have begun to drop almost in a straight line. In 2020-2021, our private investments hit a record low of 19.6% of our GDP. Some economists suggest that investments dropped because India's private consumption expenditures are low. But maybe there's another prominent reason. In one of the older episodes, I had referred to an editorial by economists Josh Feldman and Arvind Subramaniam. To give you a quick summary, they said that investing in India can yield great returns, but it also comes with very strange risks. They said that in India, there is always an off chance that your investments will suddenly lose its value because the government policies could turn away from you. To make things worse, this risk is not just for the future, but could also be applicable retrospectively. Something similar had happened with Vodafone and a few other companies back in 2011, and that very thought may be scaring private investors away from investing in India. But according to a recent report from the RBI, private investments in the country seem to be picking up once again. In FY 2023-2024, private companies managed to raise 5.6 lakh crore rupees from banks, IPOs and external borrowings for 1505 projects as compared to 3.5 lakh crores in FY 22-23 for 982 projects. Now that is pretty good considering everyone has been cribbing about the lack of private investments in the country. Now it's not that all of this 5.6 lakh crores will be spent in the same financial year. These investments happen in phases over multiple years. Of this total money that is intended to be invested, the expected capex for this financial year is expected to increase substantially from 1.59 lakh crores in 2023-24 to 2.45 lakh crores in 2024-25. Now do remember that these are just investment intentions and not final investments. This means some of these investments can fail to materialize. There is also the fact that project estimates are revised upwards and downwards, or there could be significant delays. But that said, investment intentions do serve as a very important early indicator. It gives us a directional sense of whether the private sector is even thinking about investing. So fingers crossed. Moving on to the next story, let's talk about the past, present, and the future of the Indian economy. C. Rangaraj is one of the most distinguished economists we have ever had in India. He has served a variety of roles, ranging from an economic advisor in the UPA government, governor of multiple states, a member of parliament, and most famously as the governor of the RBI from 1992 to 1997. And this was a period during which India was facing massive economic crisis and was liberalizing its economy and opening up to foreign investments. He is 91 years old now, which means he's pretty much seen the entire independent India's economic journey. On Independence Day, he gave an interview to CNBC TV 18 and he shared many fascinating insights about our economic history as well as the present day. I want to share a few things that I found very fascinating. First, speaking of the history of economic reforms, Dr. Rangarajan said that in the 1950s, for a poor, underdeveloped country like India, there was no clarity on what path it could take to develop economically. The Indian economic strategy included four key elements. First, increasing savings and investment rates. Second is a dominant role for the state in the economy. Third is import substitution on policy or trying to manufacture everything at home. And the fourth is the focus on industrialization, especially heavy industry. But by the 1970s, it had become evident that this strategy would not work. India had to make a change to this economic strategy, but policymakers missed the chance. It would take us another 2 decades to implement the harsh reforms that were required. So in 1991, India experienced a balance of payments crisis. Simply put, at the end of 1990, India only had foreign exchange reserves to finance 3 weeks' worth of imports. For comparison, India has forex reserves of $670 billion today. So in 1991, India had to pledge its gold, devalue the rupee twice, and then liberalize its economy by getting rid of the complex system of licenses, permits, and controls that was suffocating the Indian economy. Now, the Indian state took a back seat and allowed private companies and markets to flourish. India also gave up the policy of import substitution, which is trying to manufacture everything at home and embracing foreign trade. Now, considering Mr. Rangarajan is also the ex-RBI governor, he said that the Indian banking system had done very well thanks to the decision to allow private banks. He stressed the need for the competition to ensure that public banks survive and grow. Very interestingly, Mr. Rangarajan also spoke about how India can become a developed country. He said that our per capita GDP has to grow from the current level of about 2,500 USD to about 13,000 US dollars. To achieve this, the Indian economy has to grow at about 7% consistently, and our investment rate as a percentage of GDP has to increase to 35%. Currently, this is at about 33%. He also further highlighted that the recent increase in the investments rate has been due to government expenditure and has been accompanied by an increase in fiscal deficits. He said that government investment is not the answer and the government must create an investment-friendly environment where the private sector can invest heavily and be the dominant source of investment. Second, on development, he said that the government must adopt a multi-dimensional strategy. He said that the Asian tiger countries of Hong Kong, Taiwan, Singapore, and South Korea adopted a one-dimensional economic growth model that focused solely on export-led growth. He says that this model is no longer possible in today's world because advanced economies are not growing as fast as they were in the 1960s. There is also the fact that advanced economies, including the US and Europe, that championed free trade for well over half a century, are ironically becoming protectionists. This means that export-first strategy will no longer work for India. Third, the other and perhaps the most important thing he said in the interview was about India's monumental challenge with jobs. He said that employment in India is not growing as fast as income is. He went on to say that while jobless growth is bad, jobs without growth is also not sustainable. He also said that new technologies will only make the problem worse. He also said that new technologies will only make the problem even worse and government jobs are not the solution. All in all, this was a very fascinating interview and I really recommend you to watch it in full. You can find the link to this video in the Daily Brief newsletter. That said, let's move on to the final story of the day and talk about why the RBI governor is so worried about deposit growth. Look, it's the job of the RBI governor to be worried about things. As the head of the central bank, he'll have no shortage of things to worry about, as you can imagine. Over the course of this year, the two things he has been worried about the most are rising unsecured loans and the increasing gap between deposit growth and credit growth. Now, I know we've spoken about unsecured loans so many times on this show that you might be sick of it by now. So let me not talk about it much and instead let me focus on the second thing, which is the governor's concern about slowing deposit growth while credit growth remains high. Look, on multiple occasions, the governor has pointed out that the banks are losing out on attracting deposits and that money is going to other places. First, at FE Modern BFSI Summit in 2024, he said, and I quote,
Household and consumers who traditionally leaned on banks for parking or investing their savings are increasingly turning to capital markets and other financial intermediaries.
Second, at another event, he said, and I quote, it goes without saying that there will always be some gap between the two, but credit growth should not run ahead of deposit growth by miles. Third, during the recent MPC meeting, he said, and I quote again, it is observed that alternate investment avenues are becoming more attractive to retail customers and banks are facing challenges on the funding front with bank deposits trailing loan growth. Now, based on these comments, you might assume that people are totally ignoring banks and are instead putting all their money in stocks, mutual funds, and other investments. But if you look at things very closely, the story does not quite make sense. Soumya Kanti Ghosh, who's the chief economic advisor at SBI, published an opinion piece recently and looked at this issue in a lot more details. Let me break it down for you. First, he points out that despite the concerns of RBI, Indian banks have seen a huge growth in incremental deposits since the pandemic to the tune of 61 lakh crore rupees since FY 2022. Of this, only 59 lakh crores was lent out, but even with this growth, about a third of these deposits are tied up due to regulatory requirements, which means banks cannot lend out all this money. Now, some of the deposits are lost in the system due to leakages. And by leakages, he means the deposits that banks cannot use for lending, like funds held by government in its accounts. In FY 2023, Indian households saved 29.7 lakh crores. Of this, only 3.2 lakh crores went into mutual funds and other non-bank investments. Households invested 10 lakh crore rupees in bank deposits and another 2.5 trillion in small savings. But he points out that this shift from bank deposits to mutual funds, etc., is just a change in the composition of the asset. The money never leaves the banking system. This is because the seller who sold the shares or the money that mutual funds used to buy shares ultimately stays within the financial system. So this is not a worry at all. If anything, households moving away from FDs is a good news for India. But most importantly, he points out that 30% of the 61 lakh crores is counted towards statutory requirements of RBI. That is, banks cannot lend this cash out. Finally, he points out that another form of leakage could be people paying TDS on bank deposit interest, income tax payments, etc. He says that it is true that the nature of financial requirements and regulatory structure reduced the amount of deposits that can be lent out, but that is the nature of the financial system itself. So maybe all of this is not as bad as the RBI governor is thinking it to be. What are your thoughts? I would love to know in the comments. That's all the news I have for you today. I hope you found value in this episode. I'll see you tomorrow. Take care and goodbye.